Hello and welcome to URP 475. This is the section that deals with globalization and housing. But before we look at some of the linkages between globalization and housing, it's useful to kind of consider some of the basics of housing, particularly housing in the United States. When we look at housing in the United States, I'm going to skip a few slides here. The most important thing to consider is the role of housing in the economy. Housing impacts the economy in a myriad of ways, and I've outlined some of these here. You can see that it's not just the real estate professionals, right? The brokers, realtors, appraisers, so on, who benefit from housing, employed because of housing, but also building professionals, and then other individuals in other businesses who are also impacted by housing, and we'll see how this impact occurs a bit later. It's primarily has to do with home equity. And how home equity is used to purchase consumer goods. People in the finance industry, people who provide loans for housing, home equity lines of credit, and so on. And then the government also benefits from housing because of the property tax revenues that are coming directly from homes. And now in California, property taxes are capped at 1% of the home value. This is because of Proposition 13. And the assessed value on which that 1% is based on. So if you have a house in California, let's say that you bought in 1980 for $200,000, the house property tax would be about 1%. Cities sometimes tack on various fees, so it becomes like 1% and change, 1.25%, something like that. But in 1980, that $200,000 house, in 1981, that $200,000 house would appreciate theoretically at no more than 2%. So the value would be $204,000, and you'd be taxed at 1% of $204,000. Now, this 2% appreciation that is capped, of course, does not reflect what market appreciation might be. So your house, you may have bought it for $200,000, but the market may go up by 20% in 1 year. So your house might be worth $240,000 the next year. That's 20% of $200,000. However, the government is only going to tax you on the 2% appreciation of $200,000, which is $204,000. Of course, this is only in California that we have Prop 13. Other states have different rules. So housing plays a pretty important role that impacts directly and indirectly many sectors of the economy. So when housing collapsed in 2006 and 2007, the market collapsed pretty significantly. In the years leading up to that, the market had been going up, in some places 20, 30% a year. So it created what is called a housing bubble over then. When it collapsed, it impacted all of these various direct and indirect industries that benefit from housing. Housing, as we note here, can stimulate the economy directly and indirectly. Homeowners can sell their homes or borrow against their home to finance purchases. Also, homeowners benefit from equity appreciation in the long run. Houses go up in value, so if you're able to sell it for more than what you bought it for, that is your capital gains. And then there are also substantial tax benefits that are associated with housing. We'll talk about these a little bit later. So let's talk about the collapse for a second here. The collapse happened in 2006-07, and why did this happen? Lots of different reasons for this: deregulation, housing policy, and the role of government-backed mortgages. All of these together created basically a scenario where housing prices appreciated a heck of a lot more than they normally would have. Okay, so what is deregulation? Deregulation basically allowed commercial banks, retail banks rather, like Wells Fargo or Bank of America. Now they are supposed, as you have learned earlier, because of the Federal Reserve ratio, and they're heavily and other regulations, they are supposed to keep a certain amount of cash in the bank, right? So when you go and deposit $100, the bank can't just loan it out to somebody else. They have to keep a certain portion of that as a reserve. But if you go and deposit $100 in sort of the financial investment, all banks also have financial advisors, and you don't deposit $100 into the bank, but you actually give it to the financial advisor to invest for you, or you invest on the basis of their advice. that is a separate part. That's an investment part of the bank. It's not the same thing as retail banking. So this some acts that were part of this deregulatory scheme allowed basically commercial and investment banks not exactly to merge, but to combine in ways that were not allowed before. And so what this basically allowed banks to do was take a lot more risk with your money, basically. Since banks were able to take a lot more risk with their money, banks want to lend money. And sometimes if there's a lot more money to loan, they will they will take on riskier and riskier investments. And sometimes banks are willing to take riskier investments in housing sector specifically because the government backs up some of these mortgages. Like roughly 50% of the mortgages in the United States are backed by the U.S. government. Backed meaning if you default on your mortgage, the government agencies or pseudo-government agencies known as Fannie Mae and Freddie Mac will assume that risk. They will basically bear the cost of your default. How do they do that? They do that by buying the loan that the bank has made to you from them. So imagine this. Wells Fargo makes you a loan of, let's say, $400,000 to buy a house. And they do this using a risky mortgage product such as a ARM loan, that's interest-only loan, or a negative amortization loan. These are not really done anymore because of the collapse, but they were done back then. Wells Fargo makes you a risky loan. What's a risky loan? They don't really do the homework. They make you a loan and they don't underwrite your loan properly. In other words, they don't check your income properly. They don't check your ability to pay properly, and you default on that $400,000 loan. But what Wells Fargo would typically do is after they give you the loan, they would sell that loan to Fannie Mae or Freddie Mac or somebody else, usually Fannie Mae and Freddie Mac, as they own 50% of these loans. And so ultimately, your loan is now owned by the government, right? Or what's called a government-sponsored enterprise, which is Fannie Mae and Freddie Mac. And it's no longer owned by Wells Fargo. So the risk is not really taken by Wells Fargo. Even though you're making monthly payments to Wells Fargo, they're just serving as a middleman to service the payment. That payment is going ultimately to Fannie Mae and Freddie Mac. They are part of the secondary market in mortgages. So government basically took a lot of the risk away from the banks. The banks made riskier loans by allowing banks to merge their investment and retail arms. Banks had a lot more money to play with. Well, the net result was there was a lot more loans that were being made in the United States before the collapse. And now, going back to your basic supply and demand, if you have a lot more money available for loans, people are getting loans very easily. What does that do to the price of the houses? Well, there's a lot more demand for houses, right? Because people can get loans more easily, so the price of houses goes up. But this game of musical chairs had to come to an end because a lot of the people who got these loans were unable to pay for them in the long run. A lot of the money was also coming into banks through, and this is where globalization really plays a big role. A lot of the money was flowing in from investors outside the country. They were investing in these risky mortgage products as well because there was a lot of money to be made. And so more money, the more the price of the homes went up, and there was eventually a collapse. So here we look at the role of supply and demand, again, in housing. And as I'd mentioned earlier, home prices are like, or homes are like any other commodities, and they're a function of supply and demand. And demand increases when you have a lot more money chasing a limited commodity. What's a limited commodity? The house. Housing stock or number of homes in the market is limited. So when you have a lot of demand that is fueled by cheap loans, well, prices go up and you create housing bubbles. Okay, earlier I had mentioned secondary housing markets, right? Fannie Mae, Freddie Mac. Just to clarify that again here, the primary housing market financiers are like Wells Fargo, banks, basically, and the secondary market housing financiers are like Fannie Mae and Freddie Mac. The secondary market buys loans from the primary market right here. Why is this important? Because imagine this: if a bank, and here I give you some background on Fannie Mae and Freddie Mac, but if a bank like Wells Fargo was unable to sell their mortgage, right? So Wells Fargo makes you a loan of $400,000, for example. Now, Wells Fargo is $400,000 poorer because they gave you the money to buy a house. Well, if they kept loaning out all of their money, eventually Wells Fargo would not have any money to loan out, right? So how does Wells Fargo get that money back? They sell that loan that they made to you to the secondary market, like Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are only 50% of the secondary market, roughly. There are others who are involved in this, but they have really grown disproportionately, and unfortunately, in many instances, because they were created by the government to stimulate the secondary market in housing. However, what happened was a lot of private investors did not get into the game of the secondary housing market or the mortgage market, and so Fannie Mae and Freddie Mac kept buying more and more loans. And their risk is ultimately assumed by the taxpayer because they are a government-sponsored enterprise. So again, the government here is indirectly kind of propping up the housing market. That's the thing I want you to appreciate. The United States federal government is propping up the housing market through the creation of Fannie Mae and Freddie Mac. Now, earlier I talked about home ownership and some benefits that come from home ownership. So let's talk about that here for a second. There are a lot of tax-related benefits. All of the interest that you pay on your mortgage for your home is tax deductible. So what is this interest? Let me give you an example here. If you look at the principal and interest, if you put down 20% on a $500,000 house, your loan will be $400,000. And if you have a 6% interest over 30 years, your monthly payment will be the same, which is about $23.98 at 6%. The rate is a little lower today. It's around 4%, 3.75%, but I'm just using 6% here. That was the interest rate maybe 10 years ago. So you pay $23.98.20 per month for a $400,000 loan at 6% interest. Now, in the beginning, most of this $23.98, that's the blue part, is the interest you're paying the bank. If you keep the house for all 360 months, it goes out to 360 months. You see it right here. The amount of principal that you pay goes up over time. So the total payment of $23.98 stays the same. It's the flat line. But how that $23.98 is allocated, in the beginning, it's mostly going towards interest. There's a big blue part. The red part is the principal. You're not paying much of your mortgage down. But as you hold it longer and longer, in the end, you're paying mostly principal and you're paying very little interest. So this interest right here is deductible, mortgage interest deductibility. Any property taxes that you pay, I mentioned property taxes in California are roughly 1%. So 1% of 500,000 would be about 5,000 a year. You can deduct that from your taxes as well. There's also something called depreciation for rental properties. That's a little complicated, but I just wanted to mention that. You can depreciate the actual built value of the house over 27 and a half years. If you own rental property, that's a pretty significant deduction, actually. And then you can deduct line of credit payment, the interest made on line of credit payments. What is that interest? If your house basically goes up in value, you will have a lot more home equity. And the way you can take out this home equity is you can sell your home. That means you bought your house for, let's say, $500,000. Your house goes up to $700,000. The difference between $500,000 and $700,000 is $200,000. And let's say your loan is only for $400,000 when you bought it. Your home equity would be $200,000 plus $100,000. Why $100,000? Because you put $100,000 down when you bought the house, right? That was your down payment. Again, let me rephrase that. You bought a house for $500,000. You put 20% down. That means you put $100,000 down. The bank makes you a loan for $400,000, right? Let's say you sell the house 2 years from now. You have paid down some of your mortgage, so your mortgage is not exactly $400,000, right? It's a little bit less than that. But your house was sold for $700,000. So 700 minus whatever your mortgage is. So let's say it's around 400. So 700 minus 400 would be about 300,000 is your equity. You can take out this equity by selling your home. You can refinance your home, meaning you can get another loan and pull out some more money. You can get basically a credit card against your house, which is a home equity loan or a home equity line of credit. The difference between these two is a home equity loan is you start paying as soon as you get the loan. Home equity line of credit is you only pay interest on the amount that you borrow, kind of like a credit card. It's like a credit card against your house. So whatever interest you pay on these two products, the HELOCs, home equity line of credit and home equity loan is, as I mentioned earlier, going back to this earlier slide right here, it is tax deductible. And then perhaps the biggest tax-related benefit of owning your own home, real estate, is the rental income is not imputed, basically. So the government basically, when if you own rental property, the government will ask you to list on your taxes the amount of rent you get from your rental property. And then the government will let you deduct your expenses, your interest, property taxes, depreciation, and so on. Now, if you own your own home and you live in your own home, that's called your primary residence. You don't have to impute your rental income, but you still get all these benefits. So do you understand this point? It's very, very important. There is no imputation of rental income for your primary home. In other words, because you're making a mortgage payment to that home, you can deduct the interest, but you are not increasing your income that you would have paid to yourself if you were renting the home to yourself. Now, this is kind of a subtle and somewhat complicated point, but the sort of the take-home message here is if you're trying to get a tax benefit from a rental property, the government would make you list the rent you got from that property on your taxes. So your income would go up by the rent that you got for the property, and then you could deduct your interest payment, your repairs, and so on, and your property taxes on the rental property. However, with your primary residence, the residence that you live in, you don't have to impute this rental income, which is a huge, huge benefit. So here again, we look at how equity builds in your house, basically, your mortgage, what your house is worth. The difference between what your house is worth, that's the whole house, minus your mortgage debt is your equity. Over time, your equity grows, and you can extract this, the different ways we just talked about, home equity line of credit, home loan, sell your house, refinance your house. I give you an example here of how you can buy stuff with your house. And, again, the interest payment you make on a line of credit against your house is tax deductible. So in a very weird way, you can use your house to actually buy things like a car, right? And this goes back earlier to the point we were making that home ownership and if homes are rising in value and people are extracting money out of the house has a very big impact on consumer goods, because people can use their home equity to buy all kinds of other consumer goods. Sometimes people walk away from their house because, and this is what happened when the housing market crashed. You bought the house for too much money, but the price of the house went below what you owed for the house. So your debt was actually more than what your house was worth, and it's not really worth keeping if your debt is a lot, so people just walk away. So, why is homeownership so pushed in the United States? Well, there's a lot of benefits associated with that. And of course, the biggest one is the long-term appreciation of the housing price, which leads to an increase in your housing equity, which you can take out using lines of credit and other types of products to buy stuff. This is why when the home prices went up a lot in the years leading up to 2006, before the crash, people were buying a lot of stuff. The economy was booming because of housing. So this is the link between housing and globalization. Globalization basically allows a lot of money to be funneled into a particular housing market. Now, I give the example of Vancouver in another link that I posted. Vancouver and other housing markets, and in Southern California in recent times also, has really benefited from the influx of foreign capital. And that's because of globalization. Money moves around pretty freely, and as soon as people are able to move their money around freely, they kind of jack up the prices in places like Vancouver, Southern California, Florida, New York, and so on. Much to the detriment of people who actually live there, who can no longer afford to buy homes there because they're competing with foreign money. So, but homeownership builds equity, and there's other social benefits associated with homeownership. All the evidence for this is less strong. It seems that homeowners are more invested in their community. They have higher self-esteem. The kids tend to do better, tend to participate in politics, local politics more, and so on. So some benefits are there that are not just about money. Okay, I wanted to kind of end on by looking at housing need. Now, housing need is basically along two different lines. One line is housing quality is poor. So people are living in homes that they can afford, but the housing quality is poor. They don't have heating, or they have asbestos or they have lead paint or something like that, or the house is poorly maintained. Basically, so the housing quality issues. These are actually not as important in the United States. They are important, and the next section we'll look at slums in developing countries, but they're less important in the U.S. What's really kind of a big deal in the U.S. is housing cost burden. And basically, what this is when somebody is paying much more than 30% of their income towards housing. We call that cost burden. If you're paying more than 30%, if you're paying more than 50% of your gross income, you are severely cost burdened. And this cost burden in this bullet point I'm showing you can also lead to crowding. Crowding sometimes is sort of it's a difficult to sort of measure issue because Department of Housing and Urban Development says 1 to 1.5 persons per room is about the max a house can sustain. So by per room they mean if you have a 2-bedroom, 2-bath condominium, for example, that unit will have 2 bedrooms plus a living room and maybe a family room. So it may have like 4 rooms. So that unit can support, according to HUD, maybe max of 6 people. Now, sometimes people choose to live together because it's cheaper that way, or because of cultural reasons. Depending on the cultures that we're talking about, some people have extended families, or kids live with the parents much longer. So for a variety of reasons that have nothing to do with cost, people have larger families. Okay, in the next section, we will look at slums.